So let us go further with the discussion of amount B and the documentation that we received. So here on the left you see the Pillar 1 amount B OECD document and the transfer pricing guidelines, where it's going to become a part of, and it's going to go in as an annex to chapter 4 after annex 2, one would assume. So the guidelines start with the following sections of this report are to be added to the OECD TPG as an annex to chapter 4. And there's the executive summary. Last time we looked at the numerical calculations of everything that was chapter 5. And now we look at a little bit at about the application of this, transactions which are in scope, and then how do we deal with tax certainty. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. So when we look at the application of amount B, paragraph 7 says a jurisdiction that chooses to apply the simplified and streamlined approach may choose one of two options. 1. A jurisdiction can permit the resident tested parties to elect to apply the simplified and streamlined approach. In other words, this is a voluntary thing for taxpayers. Or 2, a jurisdiction can require the use of the simplified and streamlined approach in a prescriptive manner. In other words, it's mandatory, and thus taxpayers should apply the simplified and streamlined approach where scoping criteria are met. So now it's not a safe harbor, it is a compulsory measure to follow. And then paragraph 8 goes on to say taxpayers should not rely on the simplified and streamlined approach to justify that a result is at arm's length when filing their tax returns in jurisdictions that do not apply the simplified and streamlined approach. So you cannot force a jurisdiction to do it. And it applies for both sides of the transaction, because the guidelines go on to say it would also be the case for filings in the counterparty jurisdiction where that jurisdiction has not adopted the simplified and streamlined approach, even where the tested party, in other words, the distributor, is in a jurisdiction that has adopted it. So if the distributed jurisdiction follows the simplified and streamlined approach, but the principal jurisdiction does not, you cannot apply the simplified and streamlined approach. And then let's look at transactions in scope, and the language is a little more complicated here. So it starts by saying the following transactions are qualifying transactions. A, buy, sell, marketing and distribution, where the distributor purchases from associated enterprises for wholesale distribution to unrelated parties. So we already see it is limited to wholesale distribution. And B, sales agency and commissionaire transactions, where the agent or commissionaire contributes to associated enterprises wholesale or distribution of goods to unrelated parties. Again, only wholesale. And then the guidelines define what wholesale is. It says wholesale distribution is distribution to any customer except end customers. A distributor engaging in wholesale and retail distribution is deemed to solely carry out wholesale distribution if its net retail revenues do not exceed 20% of its 3-year weighted average net revenue. So when you do sell to consumers, but it is less than 20% of your total average net revenue over the past 3 years, you are still in scope for the transactions. But that's not the end of the story. For a qualifying transaction to be in scope, it also needs, 1, it should be reliably priceable under a one-sided method with the distributor as a tested party. Now this makes sense, right? Because that is what you would normally do with a distributor or an agent. And 2, the distributor OPEX must be between 3 to 20 or 30% of the annual revenues, and the countries decide whether it's 20 or 30. I get this. I mean, you have an OPEX upper limit because you want to make sure that your distributor does not do more functions than the benchmark distributors in the amount B report. On the other hand, you have these OPEX adjustments that you can apply. So I don't understand why you need both. And I am a little worried that 20 to 30% might be too low in many circumstances, and it should have been 3 to 30 or 40% instead. But we'll see how this plays out in practice. Paragraph 14, a transaction will nonetheless be out of scope. So even if you pass the first 2 gateways, if 1, it involves the distribution of non-tangible goods, so it's only for tangibles, services, or the marketing, trading, or distribution of commodities. And the underlying idea reading the text about commodities here is that commodities have public prices. We don't need to have a benchmark for the margin of the distributor. I think that is unnecessarily narrow in this particular case, because you still have a distributor, but the OECD is correct in saying, if you have cups, you have to apply your cups. However, I think it's a missed opportunity. And B, it will also be out of scope if the tested party carries out non-distribution activities, such as manufacturing, for instance, unless the qualifying transaction can be evaluated and priced on a separate basis. So if your accounts are separated such that you can allocate the cost for distribution versus the cost for manufacturing, and income from distribution versus the income from manufacturing, you can still apply the simplified and streamlined approach. And then this issue of commodities, we get a definition of that, and it says the exclusion is broad in nature and includes the trading, marketing, or distribution of products of commodity nature, with or without a quoted price, right? And again, here you come to that cup idea. It includes a commodity which has undergone a qualifying processing. A commodity can be any of the following: A physical product, primarily derived from the Earth's crust, land, or water. So these are natural resources. These can be in a solid, liquid, or gas state, and can be a hydrocarbon, a mineral, a mineraloid, or an agricultural product. And I'm not quite sure why we have agricultural products in here, right? So I assume that if you sell carrots out of the ground, you cannot use the amount B. Now, there's not going to be a lot of 750 million euro enterprises selling carrots out of the ground directly. But what about canned products, canned carrots, and issues like that? I think there's going to be some uncertainty here. There is no B, but the next letter is then C. A commodity is also a physical product that has undergone qualifying processing. So, again, if we take our carrots out of the ground and we put them in a can we now distribute them under the simplified and streamlined approach? Yes or no? I am not sure. And then D, a commodity provided for in paragraph 218 of the guidelines, and 218 of the guidelines say commodity shall encompass physical products with a quoted price used as a reference by independent parties to price uncontrolled transactions. So here's the idea again: you have a cup, you apply the cup, you don't look at the profit margin of the distributor. Again, I think if you consider the other comparability factors, this is not going to apply to all commodities, because there are more comparability factors than just the characteristics of the goods, not the services, because they are out of scope. And then 218 also says a quoted price also includes prices from recognized and transparent price reporting or statistical agencies, governmental price setting agencies, where such indexes are referenced by third parties. So if you have a cup, use the cup is the message again. If we look at the documentation which is required, the OECD takes a very pragmatic approach within certain limitations. It says the documentation approach for a simplified and streamlined approach is built on the premise that a local file includes the relevant information and documents. So basically you have everything you need. The following items can be particularly relevant and useful in the local file: the delineation of the qualifying transaction, including the functional analysis and transactional context, e.g. where commercial or financial relations that may influence the accurate delineation. B, written agreements covering the qualifying transaction and supporting the delineation of the in-scope qualifying transaction. And C, calculation of relevant revenue, costs, and assets. D, allocation schedules showing how the financial data used in your documentation ties to the annual financial statement. So you need to be able to link your distribution, income and cost, etc. to your local annual report published by the Chamber of Commerce. There's another helpline thrown to taxpayers where the guidelines say, as a matter of good practice to avoid excessive compliance burdens for taxpayers, tax administration should refrain from requesting the taxpayer to produce or submit information already in the hands of taxpayers. I think this is useful. But then there comes another sentence, and I think this sentence also, with the inclusion of agricultural commodities and the inclusion of, that this amount B can be made compulsory instead of voluntary, so taxpayers don't only choose it when it leads to the least taxable income, shows that there are some countries which are nervous about amount B, and they were worried about abuse, and so the OECD had to include some language to appease these countries to get them to sign on to amount B, right? So what does paragraph 66 say? It says, when the taxpayer seeks to apply the simplified and streamlined approach for the first time, it should include a consent to apply the approach for a minimum of 3 years and notify that circumstance to the tax authorities of the jurisdictions involved in the qualifying transaction. So let's say you have a principal and you've got distributors that are qualifying. You either request in the qualifying in the distributor jurisdictions that you're allowed to apply amount B, or you request it in the principal jurisdiction. And if you request it in the distributor jurisdiction, then you need to let the principal jurisdiction know that you've got the approval. Or if you request it in the principal jurisdiction, you need to let all the distributor jurisdictions where you apply this know that you got the approval from the principal, right? And then it goes on to say, as part of the first time notification procedure, tax administrations could require the taxpayer to provide items of information listed in paragraph 60 here on the left-hand side, and to provide a written contract signed prior to the occurrence of the qualifying transaction. Again, it seems like there are very nervous jurisdictions out there thinking that amount B might not be enough or might only be applied when it is the cheapest option. And then the question obviously is cheapest for whom, the distributor or for the principal. If we look at tax certainty, the OECD talks here about the role of amount B in MAP procedures. And it starts by saying taxpayers on filing for a mutual agreement procedure, a MAP, where one or more of the jurisdictions has not chosen to apply the simplified and streamlined approach, should base their position only on the remainder of these guidelines. In other words, you cannot use Annex 3 to Chapter 4. You need to use Chapters 1 through 10 and all their other annexes in defending your position. In a MAP or resulting arbitration where a jurisdiction has not chosen to apply the simplified and streamlined approach, the competent authorities must justify their positions based only on the remainder of these guidelines. So this applies both for the tax authorities, the arbitrators, and the taxpayers. In such cases, the simplified and streamlined approach must not be considered or referenced. This includes for the purposes of conducting the mutual agreement. So clearly, again, the OECD needed to include language here to appease nervous countries. And then they say something interesting in paragraph 80, which makes things a little better. It says, whether or not it applies a simplified and streamlined approach, a jurisdiction may provide a corresponding adjustment that reflects the outcome of the simplified and streamlined approach on a case-by-case basis if it considers that it produces an acceptable outcome in a specific case. So when you file a MAP because one of the states made an adjustment which you think is not in line with the articles of the treaty, then the other tax authorities can look at the case and say, you know what, we're not going to go to MAP, we're simply making a corresponding adjustment because we agree with the first jurisdiction, and then the corresponding adjustment will then have to be in line with amount B, right? And if the other country doesn't agree with that, or if it doesn't apply, then you can't do this. Jurisdictions may also choose to enter into competent authority agreements with other jurisdictions to provide corresponding adjustments according to the result determined by applying the simplified and streamlined approach. And the language is a little unclear here, whether this means that jurisdictions can do that within a specific MAP case, or whether the OECD says, you know what, two tax authorities, when they conclude a treaty, can also have their competent authorities sign a mutual agreement on when it comes to distribution activities, this is how they will treat it. I hope it means the latter, because it will open the scope for applying amount B to a lot more cases, and hopefully in such a MAP it will take out this requirement that the taxpayer must request applying amount B for at least 3 years before he does so, and it simply states that, you know, once you apply amount B, you got to be clear that this is what you do and that you have to do it for at least 3 years, but you don't have to request anyone upfront whether you're allowed to do it if you believe that you qualify. So this is what the textual guidelines say on amount B. I do want to show you one more thing, and that was the OECD's benchmarking of the arm's length pricing ranges, right? So the margins of the I think it's 1.9 to 5.4%, whatever it was that we saw in the table in the previous video. And the OECD shows here the methodology that they use in applying the Orbis database for getting to these percentages. You can see the search criteria that they've used. You can see the manual review of the companies that they've done. You can see which terms they have rejected to make sure that these are not companies doing other things than routine distribution, and then their quantitative review and throwing out the commodities. For those who are not doing benchmarks on a regular basis and wonder what these things look like, this looks pretty standard from what I know, and I think it's a good way of showing us how the OECD thinks it should be done. I hope you find this helpful, and I look forward to our next time when we discuss other tax topics. Bye for now.